Welcome to TheoTrade. This is Don Kaufman. It's November 2nd, 2016. You are watching the Theo Night video. First, to start with about 8 minutes left to go in the trading day, a day that we saw the FOMC announcement. Surprise! They did absolutely nothing and really didn't even alter their statements all that much. However, still a tremendous amount of action inside of broader markets. Again, allow me to start with the S&P futures, which, again, with about 7 minutes to go now, are down about 10 handles. But that isn't really necessarily the concern of the movement. So it's very apparent now that the S&Ps have broken their downward range. That range happens to be something we've been talking about, really ad nauseum the last few weeks, specific levels. They broke through ultimately the 2112 region in the S&P futures and just continue to slip from there. Today, we're now going to close underneath 2100. I think 2100 is nothing more than a psychological level, neither here nor there. What's much more substantial right now is not per se some of the intraday trade. It's not per se that the S&Ps look like they're coming off, a bit over here. Obviously, we all recognize some of the election risk. However, there's a much broader and what feels like corrective action going on that I'm not sure a lot of people are paying attention to. Number one on my list over here has got to be the Russell. So Doc Severson pointed out last week how the Russell, and this was last Thursday, the Russell actually broke trend. And that was right at about like the 120 level. So the Russell kind of broke first. The Russell, though, now, we got to start talking about corrective territory. We're off of, in just the last few weeks of trade here, the 125 level down to the 115. So there's starting to become, if you will, statistical significance to the down moves, specifically in the Russell. All right, maybe you don't trade the Russell. That's fine. Then we'll cruise over to something like the NASDAQ. Now, one of the easiest ways, I believe, to look at the NASDAQ would be to look at the Qs, not necessarily the NASDAQ futures. Not everybody's familiar with the NASDAQ futures. The NASDAQ still hanging tough. However, the decline recently has been nothing less than violent. In terms of a percentage loss, this isn't, a few weeks like the Russell. This is literally from last week to right here, right now. Okay, so the NASDAQ is, kind of the odd man out over here? Well, no, we just saw the Russell as well. What's more disconcerting is the heavyweights of tech right now are leaving the door wide open for major sell-side activity. We no longer have Amazon as being a leader to the upside every day. We don't have Google. Okay, both stocks have declined. And again, these are substantial declines and they start to become statistically significant when we start talking about, 5-10% moves in a few of these underlyings. Yes, the underlying was involved in earnings. Okay, however, earnings were through it. And today's trading session, all right, this is a 17-point move, which is equivalent to a 2% decline inside of Google. It starts to become a little substantial there. We're going to have Facebook, which traded down approximately, 2% today. Facebook earnings are after the bell. It's neither here nor there. The decline is already underway, okay, through the broader market over here. Frankly speaking, when I look at the S&Ps, I'm surprised they've held up so well. As I'm saying that right now, we're about to actually cross through a pretty big threshold here at 2091 on the S&P futures. Again, 2091 seems to be an extreme threshold for the futures where we've seen, massive volume approaching this level. And again, you're seeing it today here with right this minute as I'm recording. I pick up different levels in the S&Ps that become much more significant over time. Well, we're right at one of them right now, right in the neighborhood of the 2091, where volume will explode. There seems to be a tremendous amount of hedging activity and risk at that particular level. Neither here nor there. In trade in the next couple of days, again, everybody is so fixated on this idea of the election that they're missing some huge points here that many stocks that have actually led the pack are in, again, and are approaching corrective territory. Now, let me bring you to an area that I think that's even more disconcerting from where I stand. And that happens to be, if I scroll down the bottom of my screen over here, I look at a lot of like volatility and term structure in volatility. Now, that might not mean much to you, but simply put, VVIX, the volatility of the volatility index, what is it doing right now? It's exploding. Now, that is not too dissimilar to what we saw back in Brexit. Again, let's put that one aside for just a second, neither here nor there, okay? Now we're actually looking at what's called the VXV. The VXV is 3-month volatility. This is the 90-day VIX. It too is drastically elevated. Why, you might ask? Well, that's a great question. It's a great question because the election, well, that's next week. Why is term and longer term volatility not just elevated, but again, becoming quite substantial in how far that volatility has been elevated? Moreover, if you want to take a quick glance at the SPX itself and you look at the SPX options, I mean the VXV and the VVIX, in the end, they're all based in some derivative form off of the SPX. But in this circumstance, if you're looking again at the 5-day options, this is November 7th, okay, versus November 9th. Obviously, that includes the election. You can see the volatility, all right, the pickup in volatility, I should say, for the 7-day options here, including the election, up to 23%. Again, that spread has now widened to almost $30 between the expiration cycles. Again, neither here nor there. The more disconcerting area that, again, I don't think that traders are picking up on nearly as much is that volatility appears to be elevating, okay, in not just the very near future. The volatility is coming up quite substantially in all the expiration cycles, which for the most part, from where I stand, means, strap in. This may not just be a short duration bout of volatility. The markets appear to be pricing volatility to be for a substantial period of time. And that's about all you can really read into in a volatility skew, okay, that's kind of flattened out as we currently have. Now, again, a few areas that I think you need to watch in the coming days. Hey, clearly technology, right? So we've got, again, Google getting smacked back, Amazon taking the brunt of it. There's our bell. So Google getting smacked back, Amazon taking a brunt of a hit today. Apple already in what we would term corrective territory over here. Facebook, well, I'll tell you what, it's coming out after the bell. So this is momentarily, you're going to see Facebook with earnings here, and ultimately the fate of technology, resting in the hands right now of nothing more than Facebook, which is a $6.33 expected move off of today's earnings announcement. Nevertheless, what you really want to focus on, and I'll leave Facebook up here for a moment, what you really want to focus on, take a look at products like financials. They closed today right at a pivotal point of 1953. 1950 is very much a line in the sand, okay, for the financial products out there. This has been a product that's been, again, rather resilient in some of recent trade. Nevertheless, okay, is holding up extremely well, again, versus, if you will, some of the technology and other sectors over here. A break in the financial products would be very, very substantial in the short duration. So all eyes, of course, on the financials in days to come. With that, I will leave you with this idea. Again, markets anticipating substantially more risk. Facebook earnings are pretty much imminent out there. Could drive some of the technology trade tomorrow. However, as we progress in this week till Thursday and Friday, we'll watch the financials and we'll watch to see if volatility, again, continues to be bid, and that is, are traders coming in and continuing to buy volatility in the back months? And that means that volatility is much more likely for the duration. So there's this, again, this assumption that with the election, that the moment the election is over, that volatility will abate. I don't see that. In fact, I see the exact opposite starting to materialize, that the election, if you will, is going to be used as nothing more than a catalyst to spark much more serious bouts of volatility. And I'm seeing that, again, throughout the volatility products. The bonds are also displaying an extremely defensive behavior. If you are looking at gold, well, look away for a moment, because gold seems to be influenced substantially by the downward momentum, if you will, inside of the dollar in some of the recent trade out there. Again, all eyes on the financials, though, in the coming days. Thanks a lot, everybody, for joining us here at TheoTrade. Enjoy the evening and enjoy, of course, Game 7 of the World Series tonight. Thanks, everybody. Bye-bye.